little bit about the quantitative aspect of investments here in Minnesota over the last 3 years, and then we're going to jump into this panel of fine entrepreneurs and investors that have volunteered their time here today, and get some questions from the audience and just have a discussion about that, and then talk a little bit about best practices as it relates to investing and entrepreneurship. We are, for those of you who don't know, Tech.mn, Minnesota's news curator for all things technology related, but so much more than news. We've got the most comprehensive events calendar as it relates to tech in Minnesota. We have a jobs board, and we've got a database, what we call the directory of all the companies and people and startups and groups that are part of this ecosystem here in Minnesota. Just want to mention Bridge.mn as well. We partnered with Project for Pride in Living, Mobile Citizens, and AmeriCorps to provide internet access, computers, and training for underprivileged youth, really all as an effort to help close the digital divide here in Minnesota. So we actively take donations. $1,000 provides those youth, one youth, with that training, that laptop, and that internet connectivity. So very important program here as we look towards the future of technology in Minnesota. So I'm going to pass it over to Jeff, and we'll talk about some of the fundraising activity here over the past 3 years.
Sure. Like everything we do, we kind of wing this on a whim last night real late, maybe early this morning too at some point. But we at Tech.mn have been tracking, I guess you could call it funding activity here in the technology industry in Minnesota for just over 3 years now. And we define technology, just to put things in perspective, as IT, software, web, mobile, hardware, systems, not clean tech, not green tech, no energy, no med device, although there's convergence in health IT and obviously software and embedded devices. But for the most part, that's the scope of technology as we're defining it in the context of this conversation, this panel, and this data that we're about to see too here. So we started in late in 2009 is when Tech.mn started, and in early 2010, the first quarter is when we really started tracking who was getting money, where it was coming from. This is done through a lot of original boots on the street reporting. It's done through a lot of different independent sources, kind of collecting and curating data to put it together so we could paint a picture and get an idea or a basis of where the industry stood here in Minnesota. Because as many of you are probably aware, everyone has an opinion about fundraising. Everyone thinks something different. But what we wanted to learn and what we wanted to share with our audience is the facts, so we could really get a good snapshot of what we were starting with, what we were working with. So we saw in the year 2010, there was $60 million that we documented as having raised by the companies. Looking into 2011, tech funding doubled according to our measure. It was actually over 120 million then in the year 2011. And in 2012 last year, we topped 145. Now it's important to note too, as many, or some of the panelists might point out, or people in this room will know, that there's a lot of activity that's off the record. There's a lot of transactions that aren't disclosed. These numbers are estimated by people smarter than us to be maybe 25% higher than what we report, just because there's always stuff happening that doesn't always get on the record for a variety of reasons. So putting these past 36 months, 3 years in perspective, we saw that 250 emerging companies, call them startups, early stage, have raised $250 million plus in the past 36 months here in Minnesota. Okay, so that's again IT, software, web, mobile, hardware, technologies of that nature, not med device, not clean tech. So the blue line bar graph are the number of companies, and the red line is the dollar amount in millions. From Q1 2010 to Q1 2013. Anybody guess what the spike is there? Code 42 software, right? Biggest raise in the past 3 years by a long shot. I think it's the largest in Minnesota in like over a decade, something like that. But in any event.
$50 million.
Yeah. So this is just kind of a real quick visual of the market over the past 3 months here. And this breaks down by subsector: health IT, edutech, hardware, SaaS, mobile, gaming, you name it. there's a way to kind of dissect and divide this information and get real granular with it. But just as a high-level overview, this is the data that we've been seeing over the past 3 years to give people here in the community broadly. We publish this information on a regular basis. It's available on our website at tech.mn. We break it down by the companies that are raising, and typically have detailed information about those companies and their product and service and contact team founders, things of that nature. If you have any questions, feel free to throw them out there anytime. Mike, keep going. We'll introduce our panel. Or maybe we'll just let them introduce themselves. Do we have a hand microphone or just these guys?
We'll do a microphone for now, just for the introductions at least. Might not pass it around for the whole panel, but we'll start with Tim.
Hi, I'm Tim Hibsch, a brand new angel investor. Really, over the last 2 or 3 years, have plugged into the tech startup community, and I feel like I have a pretty good background now on kind of some of the stuff moving around in there. Have made my first angel investment and kind of understand what that process is now. Work with General Mills in our information technology area, and also involved on a lot of different community events.
Hi, I'm Mark Marlowe. I think I know a number of you folks out there in the audience. I'm the president of Follows Venture Partners. We are a early stage venture fund. We founded ourselves in 2010. Since 2010, we've invested in 14 Minnesota companies, put about $7 million to work. We generally look at just about everything that comes in our door. So we've got some SaaS clients, some medtech clients, sensor clients, some manufacturing clients. Our investment range is typically from the low side of 125,000 up to $1 million plus per opportunity. So, and we're very flexible. We do common, preferred, stock, convertible debt. So, and again, we look at pretty much all comers here in Minnesota. We've looked at about 500 deals here in the last 2 to 3 years. So.
Hi, Jeff Hink. I'm one of the founders and general partners of a firm called Icon Venture Partners, which is a new firm. We invest in enterprise technology companies. I've been a venture capitalist since 1997. Invested probably in about 40 companies, of which 6 have been here, including Compellent, Newspeed, Sistina, TST Media, and Stratus, and Rapid Engines.
Good morning. I'm Jim Moore. I'm the CEO of Optimind Software. We're an emerging growth company here based in St. Paul. We play in the space of digital marketing, focused on pricing analytics, and just introducing some really neat products that actually just got called revolutionary in terms of being able to do cross-channel optimization between the different digital channels. Again, based in St. Paul, 30 employees at this point and growing.
Hi, I'm Adam Selke. I'm a co-founder of 2 startups in town. First startup is EchoBit, which makes a product called Evolve, which is a social network and toy chest for gamers that makes it easier and more fun to play with their friends. We have 125,000 users currently. We've raised $750,000 to date and are anticipating a Series A round sometime in the latter half of this year. The other startup is a digital products lab called Lyft, and we are currently incubating 3 products, none of which are currently funded.
Hi, I'm Clay Collins, co-founder of a company called LeadBright. We're a software as a service marketing company, and we started in June of last year. 10 months later, we have a 7-figure run rate, and it's all been bootstrapped. Our methods for making that happen are either gangster or ghetto, depending on how you look at it. But we've raised money informally through a number of different channels, none of which are orthodox. But it's been a great experience.
Thanks, Clay. And thank you to all these panelists. As you guys can see, we've got three entrepreneurs and 3 investors, kind of covering a wide spectrum of different types of investing activity and different software startups. As we roll into this, shoot me a text message if you have a question, or tweet at us, and or raise your hand. So we're going to kind of collect questions and comments from the audience in that way, those kind of 3 different methods. And go ahead, Jeff.
Okay. Just to note the way that we kind of designed the panel, we've got Clay Collins here, the bootstrapper, right? Raising money is optional. He's hit $1 million run rate without having to raise money. Adam Selke in the middle there. How much did you say you raised for Evolve? $750,000. And Jim Moore for Optimind? $7 million. And then in terms of the investors here too, you've got your VC, your super angel, and your emerging angel too. So we want to diversify the panel. If you have a specific question for any one of these gentlemen based on kind of where they fit in this picture, feel free to direct your questions at them as opposed to the panel in general. We've got maybe 20 minutes to talk here and have a conversation with everybody. And time's going to fly. We don't want to just go down rabbit holes and debate where the merits of whether we're Silicon Valley or not. So let's be constructive here. I see a question from John Whitmire. Go ahead. Let's talk about pre-revenue money.
All the money we've raised as a pre-revenue company. So it's certainly an uphill slog, but it's not impossible, especially outside of the Twin Cities. So the key to making that happen is convincing people you're on to something that's got a market, that you have a team that's capable. Certainly helps if you've done it before, right? So you can have a great team, but if you're an unknown, it's going to be a challenge for you to prove yourself. But that then leads to the next part, which is actual traction, actual evidence that you're making the right kind of progress and that you're capable of executing. And so, and then outside of that, it really falls into what's fashionable. And I hate to say that, but there's certain trends that become hot areas for investment. And if you're not fitting into some of those trends, you may find it a difficult challenge, especially on a pre-revenue basis.
So the way we did it, being bootstrapped, was we went to our market and we asked them to buy our product before it exists. We didn't go through Kickstarter. We didn't have like weird hoops to jump through. We just started up a blog, started talking about things that we're passionate about, told them that we were going to make a product, and asked them to buy it. And they did. And we got our first $20,000 that way, and then turned it into much more down the road. So we got people to buy it before it exists. People think you have to do that with Kickstarter or Indiegogo. You can build a much more meaningful relationship over time with a blog, and then you own those email addresses. You can market to those people over time. You can get them to co-create the product with you before you even make it to a much greater degree than you could with Kickstarter and Indiegogo, and you don't have to like deal with their BS. So that's another way to go, is just to like hustle.
Wait, I've got like 15 text messages asking you to talk about fundraising.
Okay.
So tell us about what you meant by that.
Sure. So there's a couple things. One thing we did was we formed a partnership with a blogger who was sort of at the top of the market. Everyone listened to this blogger. We gave them 1% of the company. They pitched us on their blog, and we raised $100,000. I mean, but that wasn't in venture capital. That was in people buying our product. So if I had to choose between $100,000 of venture capital and $100,000 of customer money, I'd rather take the customer money because it's cheaper. We have to give up less equity. It comes with word of mouth. It comes with other partnerships that are built into that. So that's one way that we did it. Another way that we did it was we formed a partnership with a developer who developed the beta version of our product for a percentage of the money that came through the cart. So they kind of volunteered their time. We gave them percentage of cart sales for a year. A third way that we did it was, again, through the pre-selling that we did. So I'm here to say, really, that you guys are entrepreneurs. Capital is a commodity, and the ball is in your court. You should call the shots. And it used to be that back in the day, venture capital is being disrupted. And it used to be kind of like the publishing industry, where everyone would sort of follow publishers and hope that a publisher would give them a shot, right? Publishers were the gods. And now with AngelList and just the internet and all the connections that exist there, the ball really is in your court. And just because your idea isn't part of a venture capitalist investment thesis doesn't mean it's a bad idea. It might be incredible. It might be poised for rapid, huge growth. And I think it's important to say that.
I guess from my perspective on the angel side, it's the leadership and what you see in the founder or the leading team there, to see that they have a passion to say, okay, this is what I really want to do. Here's the vision for where I want to go, and then also from the investing side, what's their exit strategy? How are they going to kind of move it on? Is it going to be acquired by another company, or what is their plan? Because from an investor standpoint, you don't necessarily want to invest in something that from a founder who just wants to run it themselves for the long term. They have to have a way of being able to get out of the investment.
Well, dittos on all of that, and then some. We make investments in CEOs and their management teams, so the most important thing for us is looking at the CEO. And again, half of our clients are experienced CEOs, the other half are not experienced. They're just newbies, first time out, but they had that passion. We looked at their business model, which was well prepared. They were going after a market where there was potential to generate some traction and get some customers, and therefore we make investments into, as I said, early stage companies with untested CEOs. The passion's important. But ultimately, it always comes down to, we have to ask ourselves the question, no matter how good the business model is or how good the theories are on a pre-revenue basis, is this the person I want to give money to? And will this person be able to get me an exit? Do they have the drive? Do they have the passion to do that? And so that really is, I mean, personality, it sells, even with a VC. So.
Sure. So we usually kind of look at 4 broad areas when we're making investment, and kind of rank companies along all 4 of these things. First is kind of product. We're looking at what's the problem they're trying to solve, and how unique is this compared to other things in the market, and is the approach that they're going to take something that's viable. Second, we look at the market. What's the market size, kind of competitive dynamics, substitutes and things like that in there. Thirdly is the business model. What's kind of the revenue model here? What's the customer acquisition strategy? How profitable is that likely to be? And then finally, and actually ends up being most important, as Mark had alluded to as well, clearly is the team. But oftentimes, especially in the early stages, somebody talked about pre-revenue before, which has been, I'd say the majority of my deals over my career. We don't have a very full team. We often don't have a CEO, and so it's more just whoever the people are in front of us, are these people we can start building the rest of the company around, right? If we have a technical founder, can this person deliver the product, and is this the type of person we think we can attract a VP sales, a CEO, a VP marketing to work with? And so we really look at kind of all 4 of those things. Well, sometimes it's, so if you look at a lot of our deals, a lot of them are oftentimes coming from, companies we funded before. The company might grow up, be acquired, like we'll take, case in point, like, Compellant right now, it's part of Dell. There's 1,000 people there, right? We're hopeful that, increasing numbers of those people will leave to go start something. We obviously have, pretty good insight into, who we thought was good, who wasn't. Otherwise it's, reference checks, just like with anybody else, where we call around to, where they worked before, people that we know in common that we can trust, what they have to say about the person and what they've done. And sometimes you don't have any of those things, right? And then it's, I guess kind of, gut.
Yes. Well, personality is certainly important, but let me make clear. Our due diligence is basically product, competitive environment, what's out there in the field right now raising money. We certainly do all that as well. But at the end of the day, it does come down to, any investor, will this management team, led by the CEO, be able to pull off basically the metrics or the milestones that they have put forth in their business model. And that does come down to basically sort of the passion of the entrepreneur. Does this individual present well? Can he, after he hits his technical milestones or marketing or go-to-market strategy, can this person go and try to raise a $5 to $10 million round? Can you put this person and his management team in front of some serious VCs or private equity funds that write $15 million checks? And that is certainly a part of it. And I guess there's no easy answer to that, except that we know it when we see it. So suffice to say, you're your number one cheerleader. If you're pitching an idea, and I don't care whether it's to a customer or a VC, you're trying to raise money or trying to sell your first client, you have to be your number one cheerleader. You are the number one cheerleader. So if you approach your job from that perspective, I think it's easy to convince people to give you money, assuming that you've got all the other components in place, like a solid business model that will, withstand some due diligence. So.
In an investor? I
Aside from cash, I think that's a given, right? But yeah, I think there's need to be simpatico on the vision for what you're doing. Your investors have to believe in what you're doing. I look for, at least in my angel investors that we've had to date, a degree of confidence in us to do the right thing. That we seek their advice on numerous occasions, but that ultimately we're in the driver's seat, we're driving the business, and they have implicit faith in that approach. So it's a personality fit. It's one of those things that I think does go both ways. And as an entrepreneur, you have to remember that when you're taking money from strangers, you need to be able to get along, and you know that there's going to be bumps in the road. You know there are going to be challenges, and you know that you need to be working with somebody that there's some mutual trust and respect for each other's skills.
Yeah, I'd add to that. I'd say two things. I mean, and it's a little bit different whether it's an angel situation or a VC. I think in both, but as I particularly think about angels, it's about imagine that tough time that's going to come, and what's it going to look like. In the VC world, these are professional people. They've got domain knowledge that tends to be focused in particular areas. And so to the best you can, because obviously it's not always your choice, but you're looking for the firm that is in the space, has been successful in the space that you are going into. In our case, we were very fortunate that that's what happened. It has been worth more than the money.
I'd say, I look at money as means for a partnership. The money itself, you can get money from a variety of sources, bank loans, credit cards, friends and family. There's a whole bunch of ways to get money if you can hustle. But usually in every market, there are, frankly, in every sort of sub-niche, there's 3 to 4 people who run the show. And usually if they're running the show, it's because they've had a big exit at some point. Or they're with a fund that produced a big exit in that market. And having access to them can mean everything. So, taking money as a means to a partnership where both people have a vested interest in the growth of your company. And so it's far less, to me, about money than it is about partnership. And usually, if you're casting a wide net, in my opinion, you're making a mistake. There's 3 to 4 players in your niche. It doesn't take very long to figure out who they are, and those are the people who are going to give you sort of the greatest amount of benefit for the equity that you're selling them. Remember, your equity is a product, and you're marketing that product to them, which they're buying at some price tag, and what comes with that. And so it's an offer, and you're giving away something, and they're giving you something. And so it's important to figure out what you can get in addition to money, because all money is created equal. All partnerships are not.
We got a question online before the investors. Someone asked, information for intellectual property, ever your minds,
Well, clearly, if we're looking pre-revenue, it has to be, right? But yeah, I mean, really, it depends. I mean, at the end of the day, we're looking pretty early stage, so we don't have a lot of revenue. I think really, frankly, for the stage where we're looking at things, having customers that are paying something just kind of validates it, right? And then they're obviously a better reference if they've actually deployed a product and things like that, right? So it's more about that than saying, oh, great, you've got 2 million in revenue, right? Because ultimately, we're hoping that these are, companies that'll have, 50 million plus in revenue, right? So a little bit of revenue doesn't actually mean anything in and of itself, to me at any rate. It's more just, it makes the process of kind of, validating that product, that much easier. Plus, by definition, if you're already selling something, you've got a complete product, so I don't have the product risk. So we look at that. I mean, in terms of, patent filings and stuff like that, to be honest, in the software realm where I'm playing at any rate, that's really not all that terribly relevant, to be honest.
Well, again, I agree with all that. IP can be a little tricky. I see, sometimes some of my early stage clients, who especially in software companies, they feel that they need to spend money filing for patents and engaging patent attorneys, and a lot of times, we'll advise against doing too much of that and using your equity dollars to basically fund that. The best protection against competitors is getting out there and starting to get some customers when you're in the software world and getting market acceptance. And so if you're a SaaS-based company with a piece of software or an application, try to keep it to a minimum. Just do the minimums you need to do to start the process to kind of put your foot in the door. Now again, we've looked at some product clients that actually manufacture a product, a hardware, and in those cases, IP, it is important. I mean, especially if the University of Minnesota has been working with you for a few years trying to develop a particular piece of hardware. Yeah, in which case, IP can be important. You don't want somebody just being able to, go and rip you off on the manufacturing side. So IP, it really depends on what's your business model, and the relevancy of the IP on a pre-revenue basis depends, again, on what is your business model, what are you trying to sell. But always keep in mind, almost any patent can be gotten around. So if you end up having a really big hit, this is America. I mean, people will try to compete with you, and chances are, if it's a piece of software, they'll figure a way of getting around any patents you filed.
I would say just an IP, just like an idea, is great, but what it takes is the idea of how to execute that. So how are you going to turn that into something? And that's, to me, where the real value comes in, is taking that idea and figuring out, okay, what's the business and how am I going to take steps forward to make it happen?
For us, it's been a mix, but the vast majority of it's been out of state.
Let's see, out of state, about 98% at this point in time, and Wisconsin's been a great place to raise some money.
In-state, I really haven't found a venture capital firm that has an investment thesis that's compatible with what we're doing. Out of state, we haven't formally raised, we've just talked to some people, but I had this really interesting experience with, I've just had a lot of really interesting experiences. I had this experience in LA with this venture capitalist, Mark Suster, and I went in and I thought we were gonna talk about the business and our revenue, and that's what he said he was interested in. And the whole conversation was meta. Like, it was about like how we approached him, the copy we used on our sales page. Like, it was about like whether or not I should have mentioned revenue numbers up front, and he told me that I shouldn't. I was like, you're a venture capitalist. Why should I not tell you? He's like, you need to be subtle about it. So the whole thing was like completely meta. It had nothing to do with our business. And I found that, and then I talked to Brad Feld, who was like, no, dude, you did the two right things you should have done. You told me your revenue numbers, and then you demoed the product. That's exactly the way you should do it. So there's a lot of different opinions about how to approach this, and it can be just a good experience, and I recommend everyone try.
I don't know. I think about that all the time. Our primary raise has been in California. Second has been Boston. Third has been Wisconsin. About 2 weeks ago, the state SWIB, State of Wisconsin Investment Board, which is a state organization, and the University of Wisconsin Alumni Retirement Fund, they joined together and formed a $30 million VC focused on IT. And I go, why is that happening in Wisconsin and not in Minnesota? I have no idea. There are more effective angel funds in Wisconsin than I can find in Minnesota. Maybe the problem is I'm not looking well in Minnesota. It's an interesting dynamic. And they're obviously, because we've gotten some money out of those groups, they're willing to invest in Minnesota companies. And there's going to be a bias to Wisconsin, but they will put money into Minnesota companies.
Yeah, and it really depends on where they're needing help, which changes quite a bit, right? Especially over the life of the company. But so for starters, we're always on the board of the company, right? And with a lot of our companies, I mean, we're interacting once a week, sometimes even more, right? I mean, it all depends again on kind of what the stage of the company is, where they need help, and then we've got in addition to our investment professionals, we've got this group of technology partners, which is about 50 people in our network that we bring in for all sorts of things. A lot of them are focused on sales and marketing because we find that's where a lot of the companies need the most help for the most part. If you couldn't get the product out the door in the first instance, you've got a bigger problem. But so a lot of them, it's what's the appropriate sales strategy? How do we bring in the right people on that side? And so we've got a pretty vast network, but then we've got this like I said, about a 50-person group that's more focused on this, and so we bring in the people from that to get involved with that, do a lot with like I said again on kind of the sales side, and then help recruit the right people in, et cetera. So it kind of spans the gamut, but we again it varies for each company where they need help, but yeah.
Well, usually the relationship that we have with our clients is defined somewhat definitively in our investment documents. If we're investing $500,000 to $1 million, we'll usually take a board seat. And my clients, when we invest, let's say, smaller amounts, $125,000, we're part of a larger syndicate. We certainly, again, this is Minnesota, so we most of the folks around here who sit on boards of our clients, we know. But usually we like to communicate even with our smallest clients once a month to get an update as to how they're doing against the plan they submitted on their when they raised their money. So if you're raising $500,000 or $1 million or $250,000, certainly you're going to submit to us a budget, and in that budget you're going to have a use of proceeds, you're going to have your milestones, go to market, hiring personnel, product development, et cetera, et cetera. So we will certainly look at that. We'll see how you're applying the investment dollars, and then we see what progress you're making on product development or gaining traction on the sales and marketing side. And we always find, of course, that everything slips to the right. We expect that. Just the degree to which is we like to be informed, on a monthly basis. And then, of course, that ties in with our ability then to continue funding the company, participating in the syndicate on a subsequent round, and also setting the company up, of course, knowing in advance that, okay, well, you raised $500,000 or you raised $1 million, you're slipping to the right on your customer acquisition is slower, you're burning more cash, which is always the case, it seems. And therefore, we think you're going to have to start working on your next round of financing here in the next few months. And so then we'll start helping you line that up, lining up the syndicate, getting together, trying to bring new folks into the syndicate. So really good communications with your investors, especially if they're professional investors that can help you raise money. The more you communicate with them, the better it is. The better it is for everybody. So also, one more thing is, when you bring on an investor, think of it in a way, it's kind of like getting married, because you have your company that you feel passionate about, and you're going to be selling this investor some equity securities. It's like it's kind of like giving a ring to your other half. You're going to be married for better or for worse, and so good communications helps any marriage. It helps any investment, helps any company.
Except you can't get divorced. The only difference.
That's why it's even more important. Yes, yes.
Jeff, Jim, or Adam, do you have something to say about
Yeah, I was just going to say we generally settled into a sort of a quarterly rhythm in general, where we've made formal communications and made sure we're sort of ticking and tying against our plan as we go forward. But bottom line is when you got something to say, share it. Good news is always welcome, and so when things are going on and an ad hoc message, just a quick email saying, hey, just want to tell you what happened last week or whatever, is always a benefit.
There's always a fascinating thing from the entrepreneur's side about these investors are a necessary evil, and that's just like the wrong way to think about this. I mean, embrace the relationship, and I couldn't agree more about communicating. And when there's a tough spot, that's where they can be of great help. I mean, these are experienced people. Even for the companies they haven't invested in, as I think Mark said, I mean, look at 500 different business props. So embrace the relationship and make the most of it.
One other quick comment on that point. I think also when you have bad news, don't try to sugarcoat it. This isn't a press release. This isn't a marketing statement. This is you working with your investors and being very candid, very open, very frank about what's going on in the health of your business. And in some cases, and certainly I've found in our experience, we've had some bad things happen, and we've run into stumbling blocks, and it feels really terrible, and you're in a bit of a panic, and you're worried about sharing that information. But more often than not, in that partnership, especially if it's a successful one based on trust, based on mutual respect, you find that you often get sort of picked up by your investors who say, hey, it's not all bad, that's fine, how do we go forward from here? Let's regroup. We'll issue another note, which is helpful, more money. So those are things that when you're candid, when you're open, when you're sharing good news right away, and bad news sooner than later, it helps sustain you as a company.
We have time for one more question. Go ahead.
I would say from the investor side, it's the connections that you can open the doors for that startup company to make introductions, to possibly introduce other investors to that company. It's the mentoring, it's the domain knowledge that investors bring to it, if it be in supply chain, if it be in information technology, whatever their background is, that's something that they can really bring to that partnership.
Our lead investor is a San Francisco-based VC. Probably the thing that I wasn't so surprised about was the networking capability. The thing that I didn't see, but has been quite amazing, is their appreciation about the fact that you will be doing future rounds, and making sure that the actions that we were taking were going to look very good in terms of the optics for the next round. So there were some interesting early things that I would not have put as a high priority, but the VC fund did, and they were right.
And as a company that doesn't have that type of an investor who has industry connections and who can actually help sort of open up doors and carve some paths, we sort of feel the absence of that. We haven't had a follow-on, full-on Series A, partially because we're almost starting from square zero in terms of making the right inroads with investors, because we don't have that champion who's a somebody who knows the industry and is able to actually help us lead that next round, which is challenging.
Yes. What I like to do for my clients, and my partner and I, we're very successful operators. In our past lives, we have, on separate occasions, founded companies that we've taken public. Goldman Sachs, from the kitchen table to $500 million market caps. Companies that we founded and grew. So we understand the process that our entrepreneurials, our early stage CEOs are going to be going through. The value that we like to bring to the table, and I notice this, is that we tell them, we advise them on what to worry about and what not to worry about. And that's, for a lot of my younger CEOs, that's really an important thing. Worry about A, B, and C. Don't worry about D, E, F, and G, because those will take care of themselves. And it's different with each opportunity, but that alone helps them conserve a lot of energy and a lot of sleepless nights. If you're going to lay awake at night worrying about something, worry about A, B, C. Don't worry about D, E, F. That's just, don't worry about it. You don't know what you don't know. That's why if you have an experienced VC who's played the game before, who knows how to do a successful exit, they'll know what to do. And they'll take a lot of that worrying off your hands and kind of help you get focused, especially if this is the first time for you.